4,200 is your price target for gold. We are, though, seeing a Fed that doesn't seem as willing to cut as it once was. What gives you the confidence that there are still more gains to go for the precious metal?
There's a few factors here. When we're looking at the gold market, those structural drivers are still very much intact. And here we're looking at the central bank demand. We're also looking at that wider investor appetite to want to buy gold. And those drivers are still very much there, suggesting that investors are really looking for an opportunity to rebuild their positioning, rebuild those price gains. But also, gold has factored in a lot of the headwinds already. As you mentioned, at the start of the year, the market was looking at rate cuts, and now it's pricing in rate hikes. But we've also seen gold switching its focus away from some of those structural drivers and more so towards rate cut expectations or rate hike expectations. But we think a lot of those headwinds are already priced in.
Well, how much do you have to factor in what's going on outside of gold, in the sense that bond yields are still much higher, more attractive at this point, and they don't seem to be going down? The Fed, if anything, is going to be raising interest rates. So isn't the risk against a rebound in gold?
We have seen that correlation between gold and real yields, gold and the dollar starting to strengthen again to levels that we last saw back in 2022. So certainly in the near term, we think some of these macro drivers have become much more important. But if also we go back to the start of this conflict, gold was a prime candidate to meet liquidity needs. Positioning was toppy, prices were scaling record highs. So it was coming under a lot of pressure amid liquidity needs. That has now moved on, and we're now much more focused on some of these macro drivers. But we think gold is very much focused on these risks and has priced it in. I would also say that our house view, our base case scenario, is that we don't expect the Fed to increase rates. So we think that once that positioning, nervous positioning, starts to unwind, we'll see gold focusing on the structural drivers again.
Well, to that point, you point out in your calculations that over 200 tons of gold ETFs are currently sitting at a loss. Is the bulk of the unwind over, or does that loss in itself threaten more forced liquidations?
It's really interesting because we like to look at the price levels that these positions were established, and a lot of the positioning was built around 4,500 and above. So we've been sitting at this loss-making level for quite a number of weeks, and we've seen some of that downward pressure certainly in June and in July. But we're now in the midst of a seasonally weak period for consumption. India's demand is on the weaker side, and we're still seeing gold hold up very well around that 4,000 level. So we think that's actually a positive for gold, the fact that we still have these negative ETF positioning. We're in the middle of a seasonally weak period for consumption, and prices are holding up relatively well. So we do think it's a headwind for the gold market. We think it's likely to cap some of that upside risk, but we think that this base has been tested a number of times.
So you've set a base, but how high can it go at this point? Do you rally back to where you were when the war started and everything changed, or do you just get somewhere in between?
We see 4,200 as our Q3 average, but going into Q4, we expect prices to average 4,650. So we do expect some of that upside risk to rematerialize. We do expect a retest, or certainly of the 5,000 level, but we think it will be a slower trek higher now. We're not expecting that sharp move higher that we saw at the start of the year that was really being driven by retail investor appetite. We think some of that has moderated. We think we're more likely to see structural drivers and steady demand now pushing gold higher, as we still see that reevaluation when it comes to portfolio diversification and looking for that hedge in the market as well.
For the other commodities that you track, what seems most exposed to the upside in the AI infrastructure boom? Where are you seeing that theme play out most?
I'd say the two metals mostly across the precious metals are silver and platinum. Across the metals as a whole, it's really copper that we see a lot of that playing out. For silver in particular, I think what's really interesting is that, yes, there's higher content that could boost silver demand higher, but we've also looked at the analysis on the broad industrial demand picture, and we find that the substitution risk that the solar industry is facing at the moment could actually offset some of those gains in terms of AI demand consumption. So it's quite a murky picture when we're looking at the industrial outlook. And of course, there's factoring in the risks around whether the AI demand boost will continue or whether it will start to moderate. But we do still see strong demand growth for silver and platinum on the back of AI demand.